Today, our presenter, Jason Bukowski, will outline how inflation is impacting the commercial insurance market and how our team at Shepherd Insurance helps our clients navigate these challenges. The recorded version of this webinar will be available following the completion of this session. You can look for a link to the recording and the slide deck for reference emailed to the email you registered with in the coming days. We'd love to hear from you, but we ask that you please hold all questions for our Q&A session toward the end of this presentation. However, the chat will be open and monitored throughout the entire webinar if you need clarification. For those of you just joining, welcome. Today's webinar will be presented by Jason Bukowski, a partner here at Shepherd Insurance. Jason has been with Shepherd Insurance since 2011 and has worked in the insurance industry for over 18 plus years. His unique experiences allow him to better understand the operational challenges that lie within the business world and have prepared him with solutions to everyday common issues. He is passionate about establishing long-lasting relationships with his clients and prospects to better understand how to help them with their risk management. Jason, the floor is yours.
Well, thanks, Mary Ashley, and thanks to all of you for joining today. This is the first time I've done this. So Mary Ashley mentioned 18 plus years in the insurance business. I'm not sure that I'm old enough to have spent 18, almost 20 years in the insurance business, but somehow here we are. I focus on commercial insurance, employee benefits, and some of the larger commercial insurance accounts that I have the pleasure of working with: cities, towns, municipalities, schools, truck and auto dealerships. The commonality between all of those segments of business, all of those clients have a large amount of property. And property is going to be what we talk about quite a bit today. It's going to dominate a little bit of the conversation. We're going to hit on some other things that are disrupted right now on the insurance markets, but property seems to be the hottest topic. We're seeing more and more stress and pressure in the marketplace, and hopefully not affecting any of you. If you haven't had your renewal yet, for our clients or prospects on the call, if you haven't had your renewal yet, anticipate some of these topics maybe coming up in your next renewal. But yeah, thanks again for having me and spending a little time with me. I know all of you are busy. On our next slide, we're going to really kick off the presentation here by talking about some definitions. I'm going to reference a lot of different insurance terms and language and lingo, and I just want to make sure that all of you on the phone are understanding what we mean when we talk about some of these things. In no particular order, we're going to talk today about co-insurance. Co-insurance is a contractual obligation to insure your property at a certain percentage. Maybe it's 80, 90, or 100% if your insurance is, your property is written that way. If we're outside of that 80, 90, or 100%, we could possibly impose a penalty. We're going to talk a little bit more about that. Agreed value is the opposite of co-insurance. Agreed value is really just an agreement between the carrier, the client, and the agent that this particular property value is enough, that it's sufficient and appropriate, and it waives any co-insurance penalties that might come up. So agreed value, opposite of co-insurance. Replacement cost, the opposite of replacement cost is actual cash value. A majority of the property that we write for our clients is written on replacement cost. That covers the cost of the repair with the same quality, comparable quality and kind, to make sure that if a damaged roof, for example, is damaged, we're going to put a brand new roof and we're going to pay for a brand new roof. Reinsurance, we're going to talk quite a bit about. Reinsurance is actually purchased insurance by our carriers, the ones that are providing you your insurance. We're going to talk about how reinsurance rates are driving some of your increased expenses this year. Percentage deductibles is an alternative. Percentage deductibles we're seeing mostly on rooftops related to wind and hail. We're going to talk about that. Most of you probably have a standard $1,000, $2,500, or $5,000 property deductible. That's your risk share. Percentage deductibles, again, for rooftops have become more and more common. We're going to talk about that. If you see the acronym TIV, that stands for total insurance value. That's the addition. If we're going to add up all of the values to your property, your buildings, your inventory, all of those things together creates the TIV. We'll talk about why that's important. The main crux and the driving factor in our discussion today is how insurance is adjusting and moving in light of inflation. This country has seen some record inflation, more inflation than we've seen in many, many years, which has put additional stress on the insurance markets, which again, we're just now having to deal with. In 2021, inflation, the annual inflation rate was 7%, 6.5% in 2022. We have seen inflation start to cool. Everybody is happy about that. Current inflation rates in 2023 through the end of June is hovering somewhere between 3 and 4%. We're going to talk about how that's causing a little bit of disruption in our industry. And then finally, loss ratio. Loss ratio is the driver of premium, both for you as an individual insurance buyer, but also for our carriers. Our carriers look at what their overall loss ratios are. We're going to talk about how that impacts next year's and pricing on that. So again, just some brief definitions as we kind of maneuver through the PowerPoint today. So you may hear in the marketplace as you visit with your agent or as you read in media a term called a narrowing or a hardening of the marketplace. So what is that? That's a tightening or increased stringency in market conditions, which is leading to some significant changes in products. Rate increases, again, commercial property in particular, premiums are up estimated 20% here at the start of 2023. Your individual property premiums may be better than that, may be worse than that, depending on your experience there. But overall, the industry is going to average this year a 20% bump in premium. We've got capacity restrictions, and so we're seeing a narrowing of appetite as it relates to how much insurance carriers are willing to quote. We've seen some of the first questions when we take a new prospect to the marketplace and we're talking to our carriers and we're saying, hey, would you be interested in quoting this opportunity? The first question they're asking us is, what's the TIV? What's the total insurance value? And some of our clients have a lot of property values out there. And so when we're talking about prospects that have 10, 20, $50 million of total insurance value, some of the carriers that were competing for that business last year and the year before are this year saying, no, thank you. We'd rather not compete. We're not writing that much insurance right now. And so again, the capacity for some of those higher TIVs, some of you may be on the call, is getting smaller and smaller. We always talk about in the absence of competition, premiums go up, costs go up. And so we don't want a narrowing of competition. We want as many carriers out there competing for your business as we could find. Unfortunately, the environment is putting some restrictions on that. We're seeing carriers bring us changes in terms and conditions, even on our renewals. We're seeing minimum deductibles that are rising. We're seeing carve-outs for things like wind and hail. If your business is in a Gulf state or a coastal state, if you're in the state of Florida in particular, you're seeing quotes that are coming back that exclude wind, that are putting percentage deductibles on named storms. And so as insurance carriers are feeling more and more pressure, as their loss ratios continue to go in a negative way, they're reacting to that. They're changing the rules of the game a bit to try to swing that profitability back into their favor. We're going to talk a little bit more about that. And again, we've talked a little bit underwriting appetite changes. So when you hear the word underwriting, essentially as an agent, my job is to build a story, build a narrative to try to get to know you as the business owner as well as I can. Because the better news I share about you, the good habits that you have, the good housekeeping that you have, the alarm systems, the cameras, the sprinkler systems, the last time ISO inspected and was it a good ISO score? All of those things, we're building a narrative to try to attract as many carriers as we can. And we also use that to drive down premiums. So we're going to talk about how carriers are getting a little bit more selective. Our clients are having to check many more boxes as it relates to loss control, good housekeeping, all those best practices that maybe in previous years have been a little bit flexible. They're becoming more and more strict as we get into 2023. So let's talk on the next slide here. What's driving insurance costs? We're going to spend quite a bit of time on this one. So catastrophic losses are certainly driving both property and liability premiums. They're creating chaos a little bit. They're driving loss ratios in a negative way for our carriers. The next slide, we're not going to go there yet, but on the next slide, we're going to highlight in 2022, there were 18 catastrophic weather-related events in the United States, which gathered over $1 billion of losses each. Let's pause on that a minute. 22 weather-related events, each one of them having over $1 billion of losses. That's certainly an increased number over previous years. You may hear the term nuclear verdicts. This is a term becoming more and more popular as the severity of liability claims continues to worsen. You can't drive down I-65. So I don't know where you are, but my office is here in southern Indiana, and I-65 is our busiest and highway connecting Louisville to Indianapolis. You can't drive down I-65 without seeing a billboard encouraging you, if you've been involved in an accident with a truck, if you've been wronged or injured in an accident, call 1-800-ATTORNEY there on the billboard. There are a lot of those billboards for a reason. Those guys make a lot of money. We're seeing, again, a higher frequency in those types of severe claims, and the precedents or the benchmarks that are being set. A claim that involved maybe a permanent disability or, heaven forbid, a fatality, 2 years ago, what's going to happen? That attorney is going to look back in that particular state. They're going to find similar cases, and they're going to see what the judgments were to those cases. And these attorneys now are getting very aggressive. And so they are now adding 20, 25, 50%. And a benchmark for a particular accident in Indiana back in 2020 might have garnered a $5 million settlement. Well, now we're asking for 8. Now we're asking for 10. And we're trying to get as much as we can. Those are the types of nuclear verdicts that are driving disruption in our umbrellas and in our general liability products. Reinsurance market challenges. Again, we've talked about what reinsurance is. It's the insurance that our carriers are buying. So we've talked about 18 different billion-dollar property weather-related incidents and claims back in 2022. I can tell you, the reinsurance carriers probably didn't predict that. Nobody did. And so one thing I want you to understand about insurance, it's a wonderful industry, but it's reactionary. Insurance is always reacting to what's happened in the past. They hire really smart people with elevated math degrees to determine what's going to happen in the future. But insurance carriers have to file their rates with state insurance regulators. And those rates can't be changed until they go through their next round of filings. And so they're really using predictive modeling to determine what their claims and losses are going to be next year. And so when we have weather related, when we have new events, we have nuclear verdicts that are unprecedented, that are unpredictable. That's why loss ratios for insurance carriers have been negative now for 5-6 years consecutive. And the market again is shifting, mainly in driving insurance costs upwards. Reinsurance carriers are charging our carriers more than they ever have. And so what happens to when reinsurance carriers charge more, your carrier charges you more, you charge your customers more, all of those increased costs kind of filter down. That's how it works. But there are some stresses being caused by reinsurance markets. Inflation issues we've already touched on. Again, that's the driving force of what's happening here. I'm going to say, not knowing what current carrier you may have for your business, that in years past, your property policy has an inflation guard provision built into it. It's automatic. I'm not sure if you've talked about this piece with your agent before. Hopefully you have. But automatically, your property policy is probably raising the value of your contents and your buildings by a set percentage every single year. And that inflation guard is in there to try to keep pace with the rising costs year over year of labor and materials. If we're insuring these things, these buildings on replacement cost, we want to make sure we have enough money in there to replace them. Again, I just mentioned insurance is reactionary. In 2021, inflation was 7%, and then we backed it up with another 6.5%. Your inflation guard, which was probably 3 or 4%, depending on the carrier, did not change. And so now we've got a widening gap between what your buildings are valued and what they actually cost to replace. I'm gonna give you we'll get to a quick story later, but those are the things right now that are driving insurance costs. And so you may see in your annual review of your insurance product that the inflation guard this year might be as high as 8, 10, or 12%. This is a correction year in our industry. Carriers, again, were reacting to what's happened in the previous 18 to 24 months, and that inflation guard is changing. You're paying additional premium for that. Supply chain disruptions, that's been the buzzword of the year for the last couple of years after COVID. Supply chain disruptions are still a thing. As materials are needed to replace windows, shingles, lumber, trusses, auto parts, the longer it takes for those parts and materials to be delivered, usually the higher the claim. We see repair times being extended, which again increases the cost of the overall claim, increases the loss ratio, puts stress on next year's renewal. Labor shortages, again, a similar story. In spite of inflation, in spite of supply chain issues, our contractors seem to be as busy as ever, at least in my part of the country. If you want to build a house nowadays, you might have to wait 1.5 years or 2 years before construction can start because the contractors already are booked. And so again, that is adding to the longevity of a claim. Claims are staying open now longer than they ever have, which is, again, driving up costs. Increased costs of materials on replacement costs, particularly in property and auto. I just mentioned how long it's taking now to get these materials delivered. If you attended our last month's webinar on personal lines with Ben Coe, he talked about auto parts on average are up 20% more than expected, again, due to supply chain issues, due to a whole variety of factors. And so, again, insurance is reactionary. Your auto premiums that were established probably 12 months before your renewal probably may not have considered the time it would take for that part to be delivered and the increased cost that inflation is putting on those materials and those parts. And so auto claims are now settling for more than anticipated, again, just adding to the chaos. Underinsurance concerns, I just mentioned that widening gap that sometimes happens when inflation guard isn't there. So just a very quick story. We tell a lot of stories in our industry, but we always leave out the names. In early 2022, one of my clients had a total loss due to a fire. Luckily, it wasn't a very big building, but big enough, a couple $100,000 in value. And when the carrier came to adjust the claim, I got a phone call 2 or 3 days later, and they said, "Hey, we have a concern that that we don't have enough insurance on the building." And of course, I responded with, "That's impossible." I meet with this client 2-3 times a year. We review building values with the client. We run cost estimators about every 3 or 4 years to make sure and double check that the inflation guard is up to speed. There's no way we don't have enough insurance. Well, again, the inflation guard in those meetings that I had with the client had not considered, had not factored in a 7% and a 6.5% inflation. Now, we got very fortunate with a carrier partner that we did not have an underinsurance problem there. We got that claim paid as it should have been paid. But it really was, that experience was eye-opening to us and our agency here in Seymour, because again, we insure a lot of clients that have a lot of property. And we had an example on a very small building, comparative to some others, that we were able to overcome. But had that incident happened to a $5 million building, an $8 million building, a $10 million building, maybe overcoming that obstacle wouldn't have been as easy. And so proactively in our office, we started doing updated cost estimators on every renewal, and even recommending more on the inflation guard year over year than what the carrier was recommending. Again, because we don't want to have those conversations with our clients that we don't have enough insurance when you guys need it. So that was a learning lesson from us, and real eye-opening of again what we're talking about today, how we so quickly got to a place in time due to outside factors that we have no control over that could put some of our clients underinsured. We don't ever want to be there. So again, just a quick story and example there. And finally, insurance costs related to cyber. We're not going to talk a whole lot about cyber. We could spend 2 hours on a whole nother call on cyber. That industry is absolutely on fire. Just again, in our small office in Seymour, Indiana, we write a lot of cyber liability, and when we do, we write it with specialty carriers with higher limits and claim support of technicians and engineers, and it's the best that the industry offers. And I'm so glad that we've done that now for 5 or 6 years, really since those products started emerging into the marketplace. And I went back and looked before our meeting here. In 2021, we had 1 cyber claim in Seymour. In 2022, we had 2 cyber claims in Seymour. And through July 26th, we've turned in 8 cyber claims, again, just in our small office here in Seymour, Indiana. That's a huge, we actually 4 weeks consecutively got a call from 4 different clients telling us about a cyber attack or a cyber event. And so if you are not having conversations right now with your insurance agent, I'm asking you to do that as soon as you get off the call today. These things are happening, again, at a higher frequency and at a much higher severity. I told you we started writing higher limits. At our office here at Shepherd, we start cyber liability limits at $1 million. And all of the examples of claims that we've seen up until this year, $1 million has been more than enough. Well, last month we had our first limits claim. We had a claim that's going to exceed the limits of the policy. It's the first time it's happened for us. I believe the first time it's happened for Shepherd. Again, we're able to overcome some of those things for our clients, but that's the environment that we're in right now. And so at our renewals, we're starting to quote $2 million, $3 million, $5 million of cyber liability because that's where it's going. Every one of us on the call today is being tested. I couldn't encourage you more to be vigilant as it relates to phishing emails, as it relates to phony invoices, fake wire transfer numbers. And that's the other thing that's alarming to us. Of the 8 cyber claims that have come in, again, to our office just this year, we've had 5 different ways, 5 different types of breaches. And so the bad actors are not always going with ransomware. They're not always going with social engineering. They're not always going with the phishing emails. They're trying everything. And so, again, that's created some disruption in the marketplace. The cost of cyber liability is not going to go down. It's only going to go up. But it's going to be an essential part of your insurance program if it's not already. It's going to be something that you're going to have to buy moving forward. All right, we're going to, again, already talked about it. United States in 2022, 18 different billion-dollar weather events. You can read through those after the program here today, but that's driving a lot of the disruption that we're seeing. So let's talk about how's all this stuff impacting insurance. I'm painting a real doom and gloom picture. I don't mean to do that. One of my mentors here at Shepherd, Jeff Quetter, he has a phrase that I try to live by. We don't give good news, we don't give bad news, we just give news. It's just news. And so it's not good or bad, it's just the way it is. Don't mean to paint a doom and gloom, but I want all of you on the call to be prepared for what's here and what's coming. So again, let's talk about inflation. Rate increases are happening. And so I haven't said it yet, but hopefully you all have put 2 and 2 together here to make 4. On our renewals this year, our clients are getting hit in 2 different ways. The inflation guard is more than it has been in the past. And so if I had $10 million of total insurance value with a standard 4% inflation guard, you're going to buy next year another $400,000, right? On that $10 million of property. And that's going to come at a cost. Not a huge cost, but it's going to come at a cost. But now when we increase that to 8, 10, or 12%, you're not buying hundreds of thousands of dollars of more building value. You're buying millions of dollars of more building values. And if you're a client that has 20, 30, $50 million of insurance, and you have to buy 10 or 12% more value, that is putting some incredible pressure on your pricing. So just be prepared for that. In addition to that, we've already talked about it. Reinsurance carriers are charging your insurance carrier more for their products. And so property rates have gone up. Again, not to repeat myself, on average 20% in the industry. And so your property renewals are getting hit really from both sides. You have to buy more to keep pace with inflation, and the rate's going to be a tick more than you paid last year. Again, we've got lower capacity on there. For some of our clients that have 50, 60, $100 million of total insurance value, we've already had conversations with some of those carriers that are saying, hey, we no longer want to write that much. We're going to offer you a renewal, but we only want to write 10 million. You're going to have to go find the other 10 or 20 or 30 million to make up the whole pie. You're going to have to go buy that somewhere else. And so anytime we have to go out of the standard market into the what we call excess markets, if you're familiar with that term, the excess products come at a higher premium than the standard markets. There's less competition, and usually the riskier business ends up there. And so again, as capacity starts to shrink, we're starting to have some of those conversations. Increased deductibles. Again, depending on the TIV, we've seen deductible minimums that have gone from $2,500 up to $10,000. So we're pushing more of the risk share onto the client. We've seen percentage deductibles. Let's talk about percentage deductibles for just a second. Percentage deductibles is not a percentage of the loss. That is a really common misnomer in our industry. The percentage deductible is a percentage of the total building value to which it's attached. And so when we have, you know, lower values here at $200,000 building or a $300,000 building, and we attach a 1% deductible onto that, that's not as painful, for lack of a better term. That's not as painful as if when that building that we're talking about is valued at $5 million, $6 million, $10 million. And now when we go from a $5,000 minimum deductible, which is flat, to a 1% deductible on an $8 million building, that's a significant risk sharing. And unfortunately, those types of deductible structures are being mandated to us. That's the best you can buy in this environment. And so just be on the lookout for that. Again, we've already talked a little bit about that. Worse terms and conditions there, where they don't want to ride as much, or they're going to, pay attention to the exclusions. We might add exclusions for named storm. This quote might include an exclusion for wind. And now you have to go out into the marketplace and buy a wind-only policy. I quoted a Florida property for a client who owns property down there that's about 2 miles from the coast. And our Shepherd Florida team is such an asset to us that live in the Midwest. We lean on them and we appreciate all the help that they provide our Midwestern clients that might own insurance down there, because it's a very difficult insurance environment in the state of Florida. And so I think we received 7 or 8 different quotes, and I was a little bit surprised to see the premiums. The premiums for fixed deductible, that includes all the perils, right? Wind and hail and named storm, and averaged about 35 to 40,000 for that particular building. Our Florida agent that helped me said, hey, not sure if they're interested or not sure what a risk taker they are, but we also have a quote that excludes wind. So it includes all the other perils. It includes all the other same terms and conditions related to all the other perils there, except for wind. That premium went from $40,000 to $8,000, a $32,000 savings. Now, state of Florida, pretty big gamble to exclude wind from your insurance. I'm not sure how many people want to do that, but it kind of shows you the environment that we're in down there. That's happening again as hailstorms and derechos. You've heard that term in the social media over the last couple of years. In Iowa and in Illinois, we had one in northern Indiana earlier this year. Those land hurricanes, as those things become more and more common, don't be surprised if some of those provisions start making their way up from the coast up into the Midwest. Lastly, more restrictive underwriting appetite out there. So again, if you're a business owner on the call, whether you're a Shepherd client or somebody else's client, you're probably familiar with the old loss control visit from the carrier. Carrier sends a loss control specialist out, and they'll do a walkthrough and evaluation of your property. They'll look for trip hazards. They'll make sure that your security systems and your ANSEL systems or your water supply or your fire extinguishers have been serviced and they've been updated, or they're not out of date, they're not expired, things like that. And you'll get a report back, and some of those loss control recommendations, we call them recs, some of those loss recs will be mandatory, where the insurance carrier says, if you don't fix this, we're not going to continue to offer insurance. And some of them will be under the category of recommendations. And it's kind of like, hey, we recommend you do this. You're going to be in better shape if you do it. But if you don't, we're still going to offer you insurance. Okay. We've talked about carriers narrowing their capacity. They're being much more selective on the type of property that they want to insure. They're being much more evaluation on all of the housekeeping, on all of the processes, on the character of the account. They're now looking at those types of things much sharper than they have in the past. So my recommendation to you today would be, when you or if you get loss control recommendations, follow those, even if they're, again, just a recommendation and not mandatory. We want to put our clients in the very best position to be competitive for next year's renewal and the year after that. It's kind of like we're all taking an exam, and our underwriters, they're already giving us the answers to the test. We know what the answers are. And so our job at Shepherd as consultants, as business partners of yours, is to share those answers to the test ahead of time, making sure that you're prepared for the exam. And the exam is going to be the renewal date, or it's going to be when a carrier is competing for your business as new business. And so pay attention to those things. Those things are under a microscope these days. Okay. So who are Shepherd? Again, for those of you who aren't as familiar as others on the call, we really appreciate you allowing us to introduce ourselves to you. Shepherd's one of the top 50 largest independent insurance agencies in the country. We're the largest in Indiana, and with offices in 6 different states, all the way from Arizona here to Ohio, and growing. And so 500 plus employees, 100 plus carriers represented, over 100,000 different policies represented. And so the reason we tell you that, if you don't have that close relationship with your broker who's having these types of conversations with you, and you would like to develop maybe a new relationship, we'd appreciate an opportunity to introduce ourselves to you specifically and see if we can help you as we move forward, again, in a really difficult insurance environment. So we've got 2 types of insurance agencies out there. You've got what we call captive agents that represent one carrier. And then you have the independent agent. We get to represent, again, at Shepherd. We're so fortunate, because of our size, to have over 100 different carriers. The captive relationship, there's some very good agencies out there, some very good companies out there in a captive model. But they kind of have a take it or leave it, right? This is your renewal. This is the pricing. This is the best we can do for you. And sometimes maybe in that captive environment, we're not able to give you other options. As an independent agent, we want to make sure that our clients value the relationship with Jason and with Jessica and with Laverne and with Michaela and all the people that work in our Seymour office. But maybe the insurance product that they buy needs to change, needs to move. Maybe we need to create that competition every 3 to 5 years to take an evaluation of the marketplace to make sure that the carrier that they're with is still the most competitive and still offering the best product. An independent agent allows you to do that. And so we'd love, again, if you're not a Shepherd client, we'd love to be able to introduce you to more of those reasons to do business with an independent agent. Okay, we're almost finished. I really appreciate your time today, but I wanted to kind of close on this. If you're not doing these things right now with your agent, again, would encourage you to set an appointment soon, because the environment that we're working in right now is kind of demanding some of these things happen. We want to make sure you're having at least annual policy reviews. And in particular, you need to know if your property is insured based on co-insurance, or is it insured based on agreed value. We've kind of told you what the definitions are of those. It could be that you have 100, 90, 80% co-insurance. There's nothing wrong with that policy. A lot of our clients have that policy. Or again, you could have agreed value there. If you have co-insurance, the onus is on you and your agent to make sure year after year after year that your building values and your policy limits are staying within the contractual obligations that you've made. And if they get outside of those contractual obligations during a claim, again, a co-insurance penalty could apply. We call that a second deductible. We don't want anybody to have a co-insurance penalty. Those things can be avoided, again, by taking a little bit of time and having a greater understanding of our insurance program, of your insurance program. We've already talked about loss control. Again, would encourage you as you get into your renewal process, or as you might go seek other insurance options in the marketplace. Maybe you're interviewing another agent, you're getting quotes. Pay attention to those loss control recs. Pay attention to the policies, procedures that you have around housekeeping, around safety materials. Some of you in manufacturing, are you wearing your eye protection, your ear protection, your foot protection, your hand protection? Do you have guards on your machines? Those types of things. For those of you that work maybe in the wood industry, are our water supplies sufficient? Do we have enough sprinklers? And when's the last time that they were tested? All of those housekeeping things need to be checked, because again, it puts you in the very best position to compete in the marketplace. And lastly, I'm really passionate about this because it's one of my favorite things to do. We all of us in the insurance industry mostly represent all of the same carriers. You could probably go to any independent agent and get quotes with all of the carrier partners that we enjoy here at Shepherd. The difference in premium is going to be, how did that agent advocate on your behalf with the underwriter? Have you all ever heard the term, he who has the most information wins? That couldn't be more true in our industry. The more the agent, the more I understand you and the nature of your business, the quality of character and class, and the history that you've conducted yourselves, your business over all of these many years, the more opportunity that we have to fill in all the blanks to the underwriter, the better pricing you're going to get. Maybe a market that would pass because of capacity issues that says, hey, we don't want to insure that because of whatever reason. Maybe it's what you do or who you are or where you're located. Maybe it's you're a fire protection class, you're out in the country and you don't have a fire extinguisher or a responding fire department. We can overcome a lot of those objections by advocating on your behalf with the marketplace. And if that brings 2 or 3 or more markets that would have turned other agencies down, again, in the absence of competition, prices are too high. The more competition we can create for you, the better that price is going to be. And usually more competition, the better the terms are going to be. So I think that's one of the many things that sets Shepherd apart. Our agents, all of us, we advocate on your behalf. We fight for you with our underwriters. Again, try to put your best foot forward. If you don't have that relationship right now, we'd encourage you to give someone at Shepherd a call.
Thank you so much, Jason. We will now open the floor for questions. If you have something you would like Jason to address, please ask those now. If we do not get to your question today, we will respond to your questions following the end of this webinar in our follow-up information. Jason, we do actually have our first question just came in, and so we're going back to cyber. What kind of cybersecurity do I need, and what are the carriers looking for from businesses like mine?
Boy, that's a really good question. I don't pretend to be an IT specialist, for sure. I would say the way I would answer that would be, if there's a question on the application, that probably means that it's pretty important. Insurance carriers, particularly with cyber's still in its infancy stages. That product's only been around for about 5 to 7 years. It takes decades to understand trends, to grow profitability, to build reserves. That product is still an infant. It's a toddler right now. And so it continues to learn through experience what your security should be, what questions to ask. We joke all the time at Shepherd with our clients that the applications for cyber used to be 1 page and 4 questions. No kidding. How many employees do you have? What are your annual revenues? What operating systems do you use? And how many customers? That's it. And we got a quote for that, and it was cheap. And what we've now see is that application is written in a language that I no longer speak, and it's 5-6 pages long. It's not 4 questions. It's now 5 pages long. And so we're recommending to our customers, take this application, get it to your IT department. Don't try to fill it out yourself if it's not your specialty. Get it to someone who understands this language and answer these questions as correctly as we can. So if we have a claim, we don't have a problem on the back end by, accidentally, inadvertently answering a question wrong on the application. If there's a question that's being asked related to multi-factor authentication, MFA is the acronym there, that's become standard operating procedure. If your business does not have MFA built into its IT network, you are virtually uninsurable in this marketplace. And there are other things as well, but I would say get your hands on a cyber application. We can get you one. If they're asking the question related to security, you probably need it.
Thank you, Jason. One more question we have in the box is, what happens if I receive a non-renewal from my current carrier?
Good question. And unfortunately, we're seeing a lot of that. Again, we've just talked for 40 minutes about all the pressure and disruption and anxiety that's being created in our industry. Well, number one, I would ask, why are you getting the non-renewal? Is it claims related? If you've had a poor claims history, sometimes to your fault, maybe not to your fault, things you can't control, that's generating non-renewals. We've also seen the type of class of business that you are. Some of these carriers, again, are getting narrower and more restrictive on the types of risks that they're entertaining this year. We've seen carriers exiting the marketplace on some types of risks. We've also seen, again, not to beat a dead horse here, property values, TIVs that are getting to 30, 40, 50 million. We're seeing non-renewals come in for that. Carriers saying, we no longer want to insure that much property. And so we're, again, very fortunate. This isn't a Shepherd commercial. This is an educational piece, but we're fortunate here to have 100 different carrier partners to find an option. You may have to go to the excess markets, again, depending on your reason for the non-renewal, and you may have to be there for 2 or 3 years until your loss runs can get a little healthier, can clean themselves up over time. But I would also say this, we saw this 3-4 years ago with commercial auto, we saw it with umbrella. It became very difficult to buy those products at competitive prices. Capacity was shrinking in umbrella as well. Here in 2023, we've had a good run in the industry. Those products are getting, that pricing is leveling. Insurance markets, they're moody. They're all they go through cycles and ups and downs. Right now, property insurance is in a bad mood, but it'll get better. We're talking about all the things that carriers are doing proactively to strengthen their loss ratios, to get themselves healthier. And when they do, again, it's a very competitive marketplace. They don't want to see people running out the door, buying their insurance from somebody else. They want to retain all their profitable business, so they're going to remain competitive. This market will turn around. It'll get easier in 2024 and hopefully a little bit easier in 2025. That would be my prediction.
Thank you again, Jason. And thank you to all of our attendees. I believe that's all we're going to have time for